Breaking news in the silver market today is not that silver price fell. That part is obvious. What actually matters, and what most people completely misunderstand, is why silver price fell immediately after making a new all-time high. Silver wasn't sold because demand disappeared. It wasn't sold because fundamentals changed overnight. It was sold because the COMEX raised margin requirements on silver futures contracts by 10%, triggering a forced mechanical response inside a leverage system. This distinction is critical because it separates emotional narratives from how the market actually functions. Margin requirements are not a side detail in futures markets, they are the control lever. When the COMEX raises margin, it increases the amount of capital traders must post to maintain their positions. This does not affect everyone equally. It disproportionately impacts leveraged participants, especially speculative longs who rely on borrowed capital to hold contracts. When margins rise suddenly, those traders must either add capital immediately or liquidate positions. Many cannot add capital fast enough, so positions are closed automatically. That creates selling pressure regardless of whether the trader is bullish or bearish. This is why silver can drop sharply, even when the broader trend is bullish. Price action following a margin hike is not a vote on silver's value. It is a liquidity event. The system is forcing weaker hands out of the market to reduce volatility and systemic risk. This is not conspiracy theory. It is openly documented exchange policy. The COMEX has always reserved the right to raise margins during periods of high volatility, and historically, it often does so after strong upside moves, not during declines. The comparison to 2021 is important. The last time the COMEX raised margins aggressively, silver dropped roughly $2 on the same day. That move had nothing to do with silver suddenly becoming less valuable. It had everything to do with leverage being removed from the system. What you are seeing now is the same playbook, executed in a higher price environment, with larger absolute price swings. When silver is trading at elevated levels, margin changes have a bigger dollar impact. This is where many investors make a fatal analytical error. They assume the COMEX is trying to crush silver because prices go down after these announcements. In reality, the COMEX is trying to crush volatility, not price. But crushing volatility in a leveraged market often means crushing price temporarily. The exchange's priority is not fair price discovery, it is market stability. If silver moves too fast, too far, too quickly, the clearing system is at risk. Margin hikes are how the exchange slows things down. This doesn't mean the COMEX is neutral. Futures exchanges are structurally biased toward large institutional players who can meet higher margin requirements easily. Retail traders and smaller funds cannot. When margins rise, the market becomes less democratic. Participation shrinks. Liquidity concentrates. That naturally suppresses upside momentum. Again, this is not illegal, it's structural, but structure shapes outcomes. Another underreported tool the COMEX has is trading halts. If price moves exceed certain thresholds in short periods, trading can be paused. These halts are justified as cooling off mechanisms, but they also break momentum. Silver, because of its volatility, is more susceptible to these interruptions than most commodities. Knowing when and how these halts can occur matters, because it explains why silver rallies often stall abruptly near key levels. So when silver dropped roughly $3 after making a new all-time high, the correct interpretation is not the bull run is over. The correct interpretation is leverage was forcibly reduced. Bull markets don't end because of margin hikes. They end because demand collapses or because macro conditions reverse decisively. Neither of those happen today. In fact, the timing of this move suggests the opposite. Exchanges raise margins when markets are overheating, not when they're weak. You don't slam the brakes on a parked car. You do it when speed becomes dangerous. The COMEX move is an acknowledgement that silver's rally had become powerful enough to require intervention at the system level. Gold matters here as well. Gold price has been rising for months alongside silver. Today's silver pullback does not erase that broader trend. Historically, silver is far more volatile than gold. It exaggerates moves in both directions. A sharp silver sell-off during a gold bull market is not unusual. It's part of how silver transfers leverage out of the system before attempting another advance. This is why experienced traders don't panic during margin-driven sell-offs. They ask a different question. Did the structure change or did positioning change? Today, positioning changed. Structure did not. Physical demand did not disappear. Industrial consumption did not stop. Monetary uncertainty did not resolve itself overnight. Only leverage was reduced. If you're still watching at this point, you're already ahead of most people reacting emotionally to today's price action. If you want analysis that explains what's really happening instead of amplifying fear, make sure you subscribe, watch until the end, and drop your thoughts in the comments, because what comes after a margin hike often matters more than the hike itself. The most important mistake investors make after a sharp sell-off like today's is assuming the move itself carries predictive power. It doesn't. What matters is what caused the move and what did not change as a result of it. The silver price dropping after a COMEX margin hike does not invalidate the bull market thesis. It simply resets the battlefield. To determine whether silver is headed lower from here or preparing for recovery, you have to separate short-term market mechanics from long-term price drivers, and those drivers remain intact. Let's start with the most overlooked factor: physical silver demand. Futures contracts can be liquidated in seconds. Physical silver cannot. Coins, bars, and industrial inventory don't vanish because margins changed. Bullion dealers worldwide continue to report strong retail demand, especially during price dips. This is not speculative demand chasing charts. This is capital moving into hard assets as a hedge against currency debasement, geopolitical risk, and systemic instability. When paper silver sells off, but physical demand remains firm, that divergence is not bearish. It's a warning sign that paper price may be underrepresenting real-world scarcity. Silver's dual role complicates things further. Unlike gold, silver is not just a monetary metal, it is an industrial input. Solar panels, electronics, medical applications, and advanced manufacturing all rely on silver's unique properties. These industries do not reduce consumption because COMEX margins changed. If anything, rising electrification and energy infrastructure spending suggest structural demand growth into 2026 and beyond. This creates a floor under long-term pricing that paper markets cannot permanently suppress. Now zoom out to the macro environment. Silver does not trade in isolation. It responds to real interest rates, monetary policy credibility, and currency confidence. Gold reaching record highs is not an accident. It reflects declining trust in fiat stability and rising sovereign debt risk. Silver historically lags gold during early bull phases and then accelerates violently later. A sharp silver pullback during a gold uptrend has often preceded stronger silver rallies, not weaker ones. What today's sell-off actually accomplished was flushing out excessive leverage. This matters because highly leveraged markets are fragile. They can't sustain long rallies. By forcing weak hands out, the COMEX effectively created conditions where the next move, if fundamentals remain supportive, can occur with stronger hands controlling more of the market. That is not bearish, that is structural reinforcement. This is where many people misread history. They look at past silver crashes and assume repetition is inevitable. But context matters. In previous cycles, silver spikes were often driven by speculative mania without sustained macro backing. Today's environment is different. Debt levels are higher. Monetary credibility is weaker. Industrial demand is structurally stronger. Central banks are still accumulating gold aggressively, indirectly supporting silver through the monetary metals complex. Is it possible silver goes lower in the short term? Yes, volatility cuts both ways. After margin hikes, markets often overshoot to the downside as fear replaces leverage, but short-term downside does not equal trend reversal. Trends reverse when demand weakens or policy tightens meaningfully. Neither is happening in a way that undermines silver's case. The real question is not whether silver will recover, it's how long it takes and how violently it moves when it does. Historically, silver recoveries after forced sell-offs tend to be fast and aggressive because selling pressure dries up once leveraged positions are gone. When selling is no longer forced, price discovery resumes. Gold's behavior in the coming weeks will be a key signal. If gold holds its gains while silver stabilizes, that divergence often resolves with silver playing catch-up. If gold continues higher, silver rarely stays suppressed for long. The metals complex moves together over time, even if short-term paths diverge. So is the gold and silver bull run over? There is no evidence to support that claim. What we saw today was not the end of a trend. It was a stress test of market structure. The system passed by shedding excess leverage that increases the odds of sustainability, not collapse. For investors, this moment demands discipline. Emotional selling after mechanical sell-offs transfers assets from impatient hands to patient ones. That's how markets redistribute wealth. Understanding the difference between price volatility and value erosion is what separates long-term winners from reactive losers. Buckle up, because volatility is not going away. But volatility alone does not kill bull markets. Loss of confidence does. And right now, confidence in paper systems remains far more fragile than confidence in hard assets like silver. Where silver goes next will not be decided by today's headlines, but by whether these underlying forces continue to build. And based on everything that actually matters, not fear, not leverage, not noise, the silver story is far from over.